The US dollar. It's something you probably see and use almost every day, whether you're grabbing a coffee, paying for groceries, or filling up your gas tank. But have you ever stopped to think about what makes the dollar so important? Not just here in the United States, but all around the world. It's the currency we use every day, woven into the fabric of our daily lives. From the smallest purchases to the biggest investments, the dollar is at the heart of our economy. But did you know it plays a huge role around the world? It's true. The US dollar isn't just America's money, it's the world's most widely used currency. In fact, it's often called the global reserve currency, because so many countries and businesses rely on it for international trade and finance. The dollar is the leading currency for global trade. When countries buy oil, electronics, or even food from each other, they often use US dollars to make those deals happen. This means that the value of the dollar can affect prices and economies far beyond America's borders. Many countries use it for buying and selling goods, and some even keep large reserves of US dollars in their central banks. In some places, people trust the dollar more than their own local currency, using it for savings or big purchases. This makes the dollar's value incredibly important. When the dollar goes up or down, it can cause ripple effects across the globe. Investors, governments, and everyday people all pay close attention to what's happening with the dollar. When the dollar is strong, it affects everything from the price of our imports to how much our money can buy overseas. For American travelers, a strong dollar means your money goes further when you visit other countries. For families shopping at home, it can mean lower prices on imported goods like electronics, clothing, or even food. A strong dollar can make imported goods cheaper for American consumers. That means you might pay less for that new smartphone or those fancy chocolates from Europe. But it can also make it harder for US businesses to sell their products abroad. When the dollar is strong, American-made goods become more expensive for people in other countries, which can hurt our exports and impact jobs here at home. Why? Because those products become more expensive for buyers using other currencies. If you're in Europe or Asia, a strong dollar means you have to spend more of your own money to buy American products, so you might look for cheaper alternatives instead. Understanding the dollar's ups and downs helps us make sense of the global economy and its impact on our lives. Whether you're a shopper, a business owner, a traveler, or just someone curious about how the world works, knowing about the dollar's role can help you make smarter decisions and see how connected we all are in today's global marketplace. What's in store for the US dollar? JP Morgan, a leading global financial institution, has made its predictions. Their research points to a strong dollar holding its ground in 2025. This forecast is based on several key factors that are shaping the global economic landscape. JP Morgan's analysts believe the US economy will outperform many others in the coming year. They also see the Federal Reserve, America's central bank, taking a different approach to interest rates than other countries. These factors, along with significant policy changes within the US, all point to a robust dollar in the near future. One of the primary reasons for the dollar's projected strength is the US economy itself. JP Morgan expects the US economy to grow at a faster pace than many other developed nations in 2025. This growth makes the US a more attractive place for investors to put their money. When investors have confidence in an economy, they are more likely to invest in assets tied to that economy's currency. In this case, a growing US economy makes dollar-denominated assets like US stocks and bonds more desirable. This increased demand for dollar-based investments directly supports and strengthens the value of the US dollar. Another significant factor that has been boosting the value of the US dollar on the global stage is the difference in monetary policy between the United States and other major economies around the world. Central banks, such as the Federal Reserve in the US, the European Central Bank and the Bank of Japan, all set their own interest rates and monetary policies based on their unique economic conditions. These decisions have a profound impact on global currency markets, influencing how investors move their money across borders in search of better returns and safer investments. Currently, the Federal Reserve, which is America's central bank, is widely expected to keep interest rates higher for a longer period compared to its counterparts in Europe and Japan. While some central banks are considering lowering rates to stimulate their economies, the Fed remains focused on keeping inflation in check, which means maintaining higher rates. This policy divergence creates a gap between U.S. interest rates and those in other developed economies, making the U.S. a more attractive destination for global capital. This difference in interest rates is a major driver of currency values. When U.S. rates are higher than those in other countries, investors can earn more by holding U.S. assets, especially government bonds. As a result, money flows into the U.S., increasing demand for the dollar and pushing its value higher relative to other currencies. This is a fundamental principle in international finance, and it plays out every day in the foreign exchange markets. Higher interest rates in the U.S. make U.S. Treasury bonds and other fixed-income securities more attractive to global investors who are seeking higher returns on their investments. These investors, ranging from large pension funds to individual savers, are constantly comparing yields across different countries. When U.S. bonds offer better returns, they become a preferred choice, drawing in capital from around the world. To purchase these U.S. bonds and take advantage of the higher yields, international investors first need to acquire U.S. dollars. This means they must exchange their own currencies, such as euros, yen, or pounds for dollars, increasing the demand for the U.S. currency in the process. This ongoing demand for dollars, driven by the desire to invest in higher-yielding U.S. assets, puts consistent upward pressure on the dollar's value. As more investors seek out U.S. bonds, the cycle continues, reinforcing the dollar's strength in global markets. This dynamic, where higher U.S. interest rates attract global investment and boost demand for the dollar, is a key reason why major financial institutions like J.P. Morgan anticipate that the dollar will remain strong in the near future. As long as the interest rate gap persists, the dollar is likely to stay in demand, shaping the global financial landscape. Beyond the familiar drivers of economic growth and fluctuating interest rates, there's another powerful force shaping the future of the US dollar: policy changes within the United States. These shifts in government strategy and regulation are playing a crucial role in the dollar's projected strength, influencing both domestic and international perceptions of the American economy. As lawmakers and policymakers respond to global challenges, their decisions ripple through financial markets, impacting everything from trade balances to investor confidence. In recent years, the U.S. government has rolled out a series of new policies specifically designed to boost domestic manufacturing and reduce the nation's reliance on foreign goods. These initiatives are not just about protecting American jobs, they're also about strengthening the country's economic foundation and ensuring long-term competitiveness on the world stage. By encouraging companies to produce more goods at home, the U.S. aims to create a more resilient supply chain and foster innovation within its borders. One of the most visible tools in this policy shift has been the implementation of tariffs on certain imports. These tariffs are essentially taxes placed on goods coming into the country, making foreign products more expensive and, in theory, giving an edge to American-made alternatives. The goal is to encourage consumers and businesses to buy domestically, supporting local industries and jobs. Alongside tariffs, the U.S. has also pursued deregulation efforts aimed at making American businesses more competitive. By reducing bureaucratic hurdles and streamlining compliance requirements, these changes are intended to lower costs for companies, spur investment, and accelerate growth in key sectors like manufacturing, technology, and energy. While the long-term effects of these policies are still a matter of debate among economists and industry leaders, there's no denying their immediate impact. By making U.S. goods more attractive both at home and abroad, these measures have the potential to significantly increase demand for American products and services. This, in turn, could help narrow the trade deficit and support job creation across the country. As demand for U.S. goods rises, so too does the demand for the U.S. dollar, since international buyers need dollars to pay for American exports. This increased demand can put upward pressure on the value of the dollar, making it stronger relative to other currencies. A stronger dollar can benefit American consumers by making imports cheaper, but it can also pose challenges for exporters by making U.S. goods more expensive overseas. Investors around the world are watching these policy shifts closely, analyzing every move to assess their potential impact on the U.S. economy and the value of the dollar. As the landscape continues to evolve, the interplay between tariffs, deregulation, and global trade will remain a key factor in determining the dollar's trajectory in the years ahead. All these factors, a robust U.S. economy, higher interest rates, and strategic policy changes, create a powerful magnet effect for global investors. They see the U.S. as a safe and profitable place to invest their money. This influx of investment capital further strengthens the US dollar. When investors move their money into the US, they need to buy dollars, increasing demand for the currency. This demand pushes up the dollar's value, making it even more attractive to other investors seeking stability and returns. This cycle of investment and dollar appreciation is a key dynamic in the global financial system. While JP Morgan's outlook for the dollar in 2025 is positive, it's essential to remember that currency values are constantly in flux. Historical cycles and long-term economic trends can shift the balance of power in the currency markets. One factor to consider is the US trade deficit. The US has a large trade deficit, meaning it imports more goods and services than it exports. This deficit means more dollars are flowing out of the US to pay for imports than are coming in from exports. Over the long term, a persistent trade deficit can weigh on the value of the dollar. Looking beyond 2025, JP Morgan's analysts have made several key predictions. They expect interest rates to remain relatively high, especially in the US. They also anticipate that the difference in monetary policy between the US and the euro area will persist. Globally, they foresee a slowdown in China's economic growth. In terms of the US stock market, JP Morgan predicts moderate growth for the S&P 500 index. These forecasts are based on a complex interplay of economic indicators, geopolitical events, and market sentiment. Understanding these trends is crucial for investors and policymakers alike.